In this video, we're going to explain how to invest in dividend stocks during a stock market crash. Before we begin, we invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. With that out of the way, let's dig into how to invest during a stock market crash. The current bull market has lasted 8 years. This is much longer than the typical bull market. Further, the S&P 500's price-to-earnings ratio is around 22, well above historical averages. Investors around the world are wondering if the next recession is around the corner, and many experts are making the case that it could arrive as soon as later this year, given the signs of slowing global growth and the current inversion of the yield curve. This, in turn, leads many investors to wonder how they can insulate their portfolios against the losses that typically accompany recessions. While it is impossible to say when the next recession will occur, investors can position themselves defensively in the event that it is coming soon. This video will discuss 3 actionable techniques you can use to position your dividend growth portfolio for the next recession. Before describing 3 actionable steps to succeed in the next stock market crash, I want to elaborate on the importance of holding your stocks during the next recession. When the markets are dropping, it might be tempting to hold cash. The wealth-eroding effect of inflation may seem less harmful than equity market risk when the S&P 500 drops by 20% or more. However, there are a number of reasons why selling your portfolio holdings in anticipation of a recession is a poor investment decision. The most notable is the opportunity cost of holding cash. Investors who incorrectly predict a market recession and sell their holdings could be left on the sidelines watching as the S&P 500 surges another 10%, 20%, or 50%. There is also the issue of capital gains tax. Long-term investing allows for the indefinite deferral of capital gains tax, creating a Buffett loan that has a profound compounding effect over the years. Selling holdings will trigger capital gains tax, which eliminates the benefits of a Buffett loan and triggers a guaranteed loss regardless of which way the markets go. Staying the course during a recession also allows investors to continue collecting dividends, which can then be used to buy more stocks on the cheap. Buying at the bottom of a recession is a fantastic way to build long-term portfolio value. The remainder of this video will discuss 3 specific portfolio strategies to minimize losses in market corrections and recessions. The first is to target dividend growth stocks. Holding dividend growth stocks during a recession is beneficial because dividends should continue to grow, in most cases, even if stock prices decline. That begs the question, how can investors find stocks likely to continue increasing dividends during a recession? The best place to begin this search is by looking for companies with proven track records of consistently increasing their dividend payments. The Dividend Aristocrats are a group of such companies, with 25+ years of consecutive dividend increases. While the Dividend Aristocrats have impressive dividend histories, they do not match up to the Dividend Kings. Each Dividend King has raised its annual dividend payout for 50+ years. This shows both an ability and a willingness to continue growing dividends during all economic environments. Aside from a rising income stream during a recession, there is another reason why holding consistent dividend growers is beneficial during a recession. These stocks have historically outperformed the market indices, and much of this outperformance has occurred during economic downturns. Over the past 10 years, the Dividend Aristocrats Index has returned 9.63% per year, while the S&P 500 has returned 6.99% per year. Holding dividend growth stocks should reduce portfolio losses during a recession and boost returns under all economic environments. The second step is buy quality and hold quality. Owning a portfolio of high-quality blue-chip stocks is another actionable way to minimize portfolio movements during a market correction. Business quality is an intangible characteristic that combines the shareholder friendliness of management, the stability of revenues and earnings, and a business model with profound longevity. The stock price of high-quality businesses will not decline as much during a recession because corporate earnings will remain relatively constant. If earnings remain constant, then a stock price decrease means a corresponding decrease in the price-to-earnings ratio, which presents a buying opportunity. Business quality can also be measured by dividend streaks, as mentioned in the last section. Companies that have grown their dividends for 25+ years are highly likely to continue growing their dividends far into the future, according to the Lindy effect. Another proxy for business quality is credit rating. Third-party credit rating agencies like Standard & Poor's or Moody's are very selective when assigning credit ratings. Owning these high-quality businesses will help protect an investment portfolio during the next market downturn. The third step is to seek out low volatility. Volatility is the tendency for a stock price to bounce around. High volatility stocks tend to have a wider distribution of returns than their low volatility counterparts. We measure stock price volatility by the statistical metric of standard deviation. Investors are generally divided about the importance of stock price volatility in portfolio management. Some argue that stock price volatility presents more buying opportunities because there are more frequent drops in individual stock prices. On the other hand, it is difficult for an investor to watch significant day-to-day fluctuations in portfolio value. Long-term investors need not worry about these fluctuations, but it can be tempting to be distracted by daily portfolio values nonetheless. Regardless of differing views on volatility, low volatility stocks tend to decline less during a recession than high volatility stocks. Large downward movements in stock prices would increase a stock's volatility, so the prices of low volatility stocks will be more stable in recessions. Naturally, investors will wonder how to identify low volatility stocks without performing all the manual calculations themselves. There are two approaches to identifying low volatility stocks: qualitatively assessing the underlying business and using market indices. Taking the first approach, we must first recognize that low volatility stocks tend to have low volatility for a reason. These companies typically operate in slow-changing industries and create products and services that are in demand through all market environments. There are actually entire sectors of the stock market that have lower stock price volatility on average. For instance, the low volatility Dividend Aristocrats have a disproportionate concentration in the healthcare and consumer staples sectors. This makes sense from a qualitative perspective. Consumers will not cut back on their health or necessity spending just because corporate earnings and market indices are on the decline. Investors can also identify low volatility stocks by looking at the constituents of low volatility indices. The major low volatility index is the S&P 500 Low Volatility Index. Just like the other two techniques discussed in this video, there are merits to investing in low volatility stocks when you're not expecting a recession. Low volatility stocks will naturally deliver superior risk-adjusted returns as measured by the Sharpe ratio. Surprisingly, low volatility stocks also deliver improved absolute returns. This goes directly against what is taught in modern portfolio theory. Higher risk, as measured by volatility, should deliver higher returns, all else being equal. The outperformance of low volatility stocks shows that this is not always true in practice. For empirical evidence of this phenomenon, consider the fact that the S&P 500 Low Volatility Index has outperformed the aggregate stock market in the long run. Thus, there are merits to investing in low volatility stocks even when a market correction is not expected. Next, we will discuss the 5 most recession-proof Dividend Aristocrats. As a starting point, here are the 5 Dividend Aristocrats that performed the best during the last recession. Exxon Mobil is the world's largest energy company based on its market capitalization of $371 billion. The company's earnings per share trend during the 2007 to 2009 financial crisis can be seen below. Exxon's earnings were volatile during the last recession, but the company remained profitable and continued to pay rising dividends each year. Exxon's stock was also surprisingly stable and had the 5th best aristocrat performance during the last recession, as its peak-to-trough price performance during that time period was a 34.5% drawdown. Next up is Walmart. Walmart is the world's largest retailer with a market capitalization of $299 billion. The company's fundamental financial performance during the 2007 to 2009 financial crisis is shown below. Walmart's earnings actually increased each and every year during the Great Recession, primarily due to the retailer's everyday low prices. This resulted in a remarkable level of stock price stability during the recession, as it had the 4th best aristocrat performance during the last recession, with a peak-to-trough stock price performance during that time period consisting of a 33.1% drawdown. Next up is the Clorox Company, which is a manufacturer, distributor, and marketer of home cleaning products, most notably its namesake Clorox Cleaner. The company's fundamental performance during the Great Recession can be seen below. Clorox managed to steadily increase its adjusted earnings per share during the Great Recession, a remarkable feat for any business. The company's stock price also fared very well, as it had the 3rd best aristocrat performance during the last recession, with a peak-to-trough stock price performance during that time period consisting of a 33% drawdown. Next up is McCormick, the world leader in spices and seasoning. The company's earnings trend during the 2007 to 2009 Great Recession can be seen below. McCormick grew its earnings at a phenomenal rate during the Great Recession. Still, the company's stock price declined along with the rest of the stock market, though not nearly as much as it had the second best Aristocrat performance during the recession, with a peak-to-trough drawdown of 33%. Abbott Laboratories is a diversified healthcare company with a market capitalization of $102 billion. The company was founded in 1888 and is headquartered in Lake Bluff, Illinois. As a healthcare company, Abbott Laboratories is very recession-resistant. The company's fundamental financial performance during the 2007 to 2009 financial crisis can be seen below. Remarkably, Abbott Laboratories managed to increase its adjusted earnings per share during each year of the 2007 to 2009 financial crisis. This growth was not slow either. Abbott Laboratories' earnings per share expanded at a cumulative annualized growth rate of 13.7% during this time period. As a result, Abbott Laboratories' stock price held up remarkably well during this economic catastrophe, as it was the best Aristocrat to own. It had a peak-to-trough drawdown of 31.4%. This video provided actionable steps to position an investment portfolio for minimal losses in the next recession. However, some might argue that positioning a portfolio for a market correction is an exercise in futility. The next recession might be years from now, be very minor, or only last a short period of time. In short, the only thing we really know about the next recession is that it is inevitable. Fortunately for investors, the investment strategies outlined in this video have not only reduced risk during bear markets, they have increased returns during bull markets as well. Thus, the strategies in this video can help investors improve performance regardless of expected future economic conditions. Thank you for watching this video, which provides an outline of how to invest for the next stock market crash. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.